Hi, welcome to my channel, Second PUC Accountancy. Learn, understand, and excel. Today, we are going to see a 12 marker under admission of a partner where the capital adjustments are to be made in cash or bank. Now, let us see the question given here for admission of a partner, and the capitals have to be adjusted in cash. So here Mahesh and Suresh are equal partners in a firm. Their balance sheet as on 31st March 2024 stood as follows. This is the balance sheet given to us. Now see on the liabilities side, first we have creditors 40,000, bank loan 8,000, capitals of the old partners Mahesh 80,000 and Suresh 40,000. So the total capital is 1,20,000. Now on the asset side, we have stock 39,000, debtors 32,000 less PDD 2,000. So after deducting, it is 30,000 in the balance sheet. Next, we have land and buildings 40,000, machinery 36,000, motor car 8,000, and cash at bank is 15,000. So the total of the balance sheet is 1,68,000 on the liability side and on the asset side. Now the adjustments given here are on 1st April 2024, Rakesh is admitted into partnership for 1/5 share in profits on the following terms. First, Rakesh should bring rupees 26,000 as capital. Second, goodwill of the firm is valued at rupees 10,000 and it should be treated as per AS 26. Third, motor car and machinery are to be depreciated by 20% and rupees 3,800 respectively. The fourth adjustment is prepaid rent rupees 600. And the fifth adjustment, provision for doubtful debts, is to be maintained at 10%. The sixth adjustment says that the capitals of all the partners are to be adjusted in their new profit sharing ratio 2:2:1 based on Rakesh's capital after adjusting goodwill. Adjustments are to be made in cash. The sacrifice ratio of old partner is 1:1. Now we have to prepare the revaluation account, the partner's capital account, and the new balance sheet. Now let's see where these items will appear from the balance sheet. Now the creditors will go to the new balance sheet, bank loan will go to the new balance sheet, and the capitals will be taken to the new balance sheet, but the new capitals will be taken to the new balance sheet. And this capital given here in the balance sheet will be the opening balance of the partner's capital account. So it will be credited to the old partner's capital account. Next, on the asset side, stock will go to the new balance sheet and any adjustments are there, it will be adjusted to it. Then debtors in the new balance sheet with the adjustment, land and buildings to the new balance sheet, machinery also will be entered in the new balance sheet on the asset side, motor car will be recorded on the new balance sheet asset side, and cash at bank also will be recorded in the new balance sheet but with the adjustments. Now we will just see how to treat all these adjustments. Now moving on to the adjustments given here as per the information, first we have the old partners profit sharing ratio. So the old partners profit sharing ratio, that is Mahesh and Suresh, their profit sharing ratio is 1:1 and that can be written as 1/2:1/2. That is the old ratio of the old partners, and in the sum they have also given us the new partners share, that is Rakesh's share is 1/5. Next, in the adjustment, they have also given us new profit sharing ratio, that is Mahesh, Suresh and Rakesh, their new profit sharing ratio is 2 is to 2 is to 1, which can be written as 2 by 5, 2 by 5 and 1 by 5. Next, in the adjustment, they have also given us another ratio, that is sacrifice ratio. So sacrifice ratio between Mahesh and Suresh is 1 is to 1. So which can be written as 1 by 2 and 1 by 2. Now moving on to the other information given to us with regard to the capital of the new partner. The new partner brings in capital, that is Rakesh brings in capital rupees 26,000. Now if you see here in the adjustment, it says that Rakesh brings only the capital to the firm. He does not bring in the goodwill. So this capital amount 26,000 should be credited to the partner's capital account, that is Rakesh's capital account. Next, if you see in the adjustment, they have given us the goodwill. The goodwill amount is to be valued at rupees 10,000. Now, how to treat this goodwill here? The goodwill of the firm is valued at rupees 10,000. Now, we have to calculate Rakesh, that is new partner's share of goodwill, that is rupees 10,000 into 1 by 5, which will be rupees 2,000. Now this rupees 2,000, which is valued on the admission of the new partner, with it has to be shared by Mahesh and Suresh in the ratio of 1 is to 1, that is in the sacrifice ratio. So Mahesh share in goodwill will be 2,000 into 1 by 2, that will be rupees 1,000. Suresh's share in goodwill will be 2,000 into 1 by 2, again it will be rupees 1,000. Now this is how the goodwill will be shared by the old partners, which is valued by the firm on admission of a new partner. So this has to be recorded in the partner's capital account. Now we will see the next adjustment, that is the depreciation. The depreciation of motor car is given as 20%. So on the motor car, the depreciation will be 8,000 into 20 by 100, which will be 1,600. Now this is decrease in the value of the asset motor car. So how to treat it? The first step is that it will appear on the debit side of revaluation account, and in the balance sheet it should be deducted from the motor car on the asset side. So this is how the depreciation of an asset should be treated. Now here there is also another adjustment which is given, that is depreciation on machinery. The depreciation on machinery is directly given to us, that is rupees 3,800. So what is the treatment for this depreciation of machinery? This is again decrease in the value of the asset. So it will appear in the revaluation account on the debit side, and in the balance sheet it should be deducted from machinery on the asset side. Now moving on to the next adjustment, we have is the prepaid rent. The prepaid rent is the expenses that is paid in advance by the firm. So therefore, it is not expenses for the firm. It is treated as income, as the expenses are paid before the due date. So the treatment for this particular adjustment will be, since it is the expenses which is paid in advance, it is treated as income. So it will appear on the revaluation account credit side, and in the balance sheet it should appear on the asset side as a separate entry, as it is not a expenses for us. The next adjustment, very important adjustment, is the PDD. The PDD is to be maintained at 10%. Here when you calculate on the debtors 32,000 into 10 by 100 will be 3,200. This is the PDD which is given in the adjustment. That is, they have asked us to maintain PDD at 10%. But there is also a PDD which is given in the balance sheet. that is the old PDD. So now we are going to compare the old PDD and the new PDD. Amount given in the adjustment is rupees 3,200. Deduct the existing PDD which is given in the balance sheet, that is rupees 2,000. So when you deduct it and compare it, we will get a difference amount rupees 1,200. That is the increase. Now if you see here, the new PDD given in the adjustment is more than the existing PDD. That means our PDD has increased, our loss has increased. So it is the increase in the PDD, or we can say it is the decrease in our asset. So it will appear on the debit side of revaluation account. This 1,200 will appear on the debit side of revaluation account. So once again, the treatment for this, rupees 1,200 will appear on the debit side of revaluation account as it is decreasing the value of the asset debtors. And in the balance sheet, we have to deduct from the debtors 32,000, deduct the new PDD, that is 3,200 on the asset side. As our PDD has increased, this is the adjustment which has to be treated. Now in this particular question, we have a new adjustment, capitals of the partners, which we will see how to treat it when we prepare the partners' capital account. Now we will move on to see the main first account to be prepared, that is revaluation account. Now this is the format of our revaluation account. So we are going to prepare the revaluation account with all the given adjustments. Now if you see here, the first adjustment is the motor car depreciated. So motor car depreciated is the decrease in the value of the asset. So it will appear on the debit side of our revaluation account. So bring down the depreciation of motor car on the debit side of revaluation account, that is 8,000 into 20%, that is 20 by 100, it will be 1,600. Now after the motor car is depreciated, in the same adjustment we also have machinery depreciated, that is rupees 3,800 directly given in the adjustment. So this is again the decrease in the value of our asset machinery. So this will appear on the debit side of revaluation account. So write it on the debit side directly to machinery, rupees 3,800. Now next adjustment is the prepaid rent. Now prepaid rent, as we had already seen, it is the income. It is an expenses which is paid in advance. So it is our income. So it will appear on the credit side of the revaluation account as by prepaid rent rupees 600. Now the next important adjustment is about our PDD. Now here when we calculated, when we compared the new PDD and the old PDD, the new PDD is more than the old PDD. It's a loss, or we can say it is a decrease in the value of the asset debtors. So it will appear on the debit side of the revaluation account as 2 PDD, that is the new PDD given in the adjustment 3,200 minus the existing PDD given in the balance sheet 2,000, which will be 1,200 in the revaluation account debit side. Now if you see here, the totals of the debit side is 6,600 and credit side is 600. So credit side is lesser and debit side is more. So write the same amount, the highest total on both the sides, that is 6,600 is the 6,600 is the highest total. So now deduct the highest total 6,600 with the credit side amount 600. So here the expense is more than the income. So it is a loss for the business concern. So it will be treated as a revaluation loss. Since the expenses are more than the incomes. So it will come on the credit side as by loss transferred to Mahesh's capital account, that is 6,000 rupees is the total loss. We have to deduct 6,600 minus 600, the credit side total. So Mahesh capital, he will get rupees 6,000 into 1 by 2, 3,000 as a share, and Suresh's capital account, he will get 6,000 into 1 by 2, 3,000 from the total loss. So both have to share the loss equally in their old profit sharing ratio. So this is the revaluation account. Now moving on to the next account, that is the partner's capital account. So this is the partner's capital account where we have Mahesh, Suresh and Rakesh as partners. So first, from the balance sheet, old balance sheet, we have to bring down the capital of the old partners as by balance brought down on the credit side, 80,000 capital for Mahesh and 40,000 for Suresh. Now once we have brought down the capital, next we have a revaluation loss. So revaluation loss, which we had calculated in the previous account, should be brought down to the partner's capital account on the debit side. So bring down the revaluation loss, which we had already distributed to the partners. So it will be two revaluation account, that is the loss. Each partner will get 3,000 out of 6,000 rupees. So 6,000 is the loss which will be shared by the partners Mahesh and Suresh, entered on the debit side. Next, now we have to bring down the new capital of the new partner who is coming in. The new partner comes in and brings in capital rupees 26,000. So this capital which is brought in by the new partner, we assume that he brings in check. As in the balance sheet, we have cash at bank. So the capital which is brought in by the new partner should be treated as a check brought in. So we write it on the credit side as by bank account. It is the capital which is brought in by the new partner, rupees 26,000. He does not bring in goodwill, he brings in only the capital. So that is entered on the credit side of the partner's capital account. Now moving on to the next year, when the new partner is admitted, the goodwill is valued. Now here the goodwill is not brought in cash, but it is only valued by the firm. So here we have to distribute Rakesh's share of goodwill, that is new partner's share of goodwill, to the old partners. So it will be written on the credit side by Rakesh's capital account. The goodwill amount, that is the total goodwill of the firm, 10,000. We have to first find out share of the new partner. So it will be 2,000 rupees, and this should be distributed to the old partners in their sacrifice ratio, which is given in the question, that is 1:1. So the goodwill of Rakesh should be distributed to Mahesh and Suresh in the sacrifice ratio, that is 1,000 for Mahesh and 1,000 for Suresh. Now since Rakesh, the new partner, is not bringing in goodwill in cash, now this goodwill which is valued should be deducted from Rakesh's capital. So here the entry will appear on the debit side as we have to reduce the new partner Rakesh's capital. So Rakesh's share of goodwill is to be given to Mahesh and Suresh. First, bring down on the debit side as to Mahesh capital, that is the goodwill which is given to the old partner Mahesh from Rakesh's capital. So we have to record it on the debit side of Rakesh's capital, as we are going to decrease Rakesh's capital towards goodwill. Next is Suresh. Suresh also will be getting rupees 1000 from Rakesh. So it will be to Suresh capital account. The goodwill which is given to Suresh, rupees 1000, should be deducted from Rakesh's capital account. So we record it on the debit side. Now, this is the entry which have to be recorded in the partner's capital account. Now, in the adjustment, it says that the partner's capital should be adjusted in cash or bank. So, before we could adjust the partner's capital account in cash or bank, first we have to find out certain calculations with regard to the new capital of the firm based on the new profit sharing ratio. So first, let us see the calculation of new capital, and then we will come back to balance the partner's capital account. Before we could balance the partner's capital account, we need to find out the new capital based on the new partner's capital, and it should be distributed to the partners in the new profit sharing ratio, and we have to adjust the partner's capital in cash or bank. So for that, first we need to calculate the new capital. Now we are going to calculate the new capital based on the new partner. So here, take Rakesh's capital after goodwill adjustment and his share as the base. So we will take the new profit sharing ratio first, that is given in the question in the adjustment, 2:2:1, or we can write it as 2/5, 2/5 and 1/5 for the new firm. So we are going to first find out the new capital keeping the new partner's capital as the base. So here Rakesh's capital after goodwill adjustment will be 26,000 minus 2,000. That is the goodwill what is being valued in the firm and distributed to the old partners, minus 2,000 will be 24,000. Now this 24,000 is the capital of Rakesh. Now based on this, we are going to find out the new capital of the firm, taking his share as the base. So what is the profit sharing ratio of Rakesh? That is 1/5. We are going to find out the reciprocal of this 1/5, where we are going to write it as 24,000 into 5/1. So the reciprocal will be 5/1. So which will be 1,20,000, the total capital of the new firm. Now this total capital should be distributed now to all the three partners in their new profit sharing ratio. So Mahesh new capital will be 1,20,000 into 2/5. That is the new profit sharing ratio. He will get the capital of rupees 48,000. And for Suresh, the new capital will be 1,20,000 into 2/5. Again, that is the new profit sharing ratio, which will be 48,000. And the new partner's capital will be 24,000, which is already given to us here in the sum. So with this, we are going to balance the partner's capital account. So this goodwill, this capital which we have derived will be the capital of the new firm. So we are going to transfer this to the partner's capital account as the balance, which will be the new capital. Now, once we had calculated the new capital of the new firm based on the new partner, now first we are going to write the new capital what we had calculated in the partner's capital account on the debit side before balancing. So we'll write it on the debit side as to balance carried down. So this is the note what we had calculated. So we had calculated 48,000 for the first partner, that is Mahesh, and 48,000 for Suresh and 24,000 is for Rakesh. Now, what we are going to do is we are going to, after taking the new capital, we are going to balance the partner's capital account. Now, whatever balance we had calculated here, that will be the new capital of the firm, which will appear in the balance sheet. We have to transfer it to the balance sheet. Now, after getting this new capital, we are going to balance the partner's capital account, and the balancing figure is adjusted in cash or bank. So first, let's see for the first partner, Mahesh. Let's get the total of Mahesh's column. On the credit side, we have 80,000 plus 1,000, which will be 81,000. And on the debit side for Mahesh, it is 48,000 plus 3,000, that will be 51,000. So if you see here for Mahesh, credit side is more. So we are going to write that total on both the sides, that is 81,000 for Mahesh. So credit side is more. So here when we compare here for Mahesh, on the debit side, it is 48,000 plus 3,000, which will be 51,000. Now deduct 51,000 from 81,000, which we will get balance as 30,000. So this balance should be entered on the debit side, which we call it as excess capital. If you see here, the capital what is invested by Mahesh is 81,000, but he has to bring in only 48,000. So therefore, the excess capital will be withdrawn by Mahesh. So we write it on the debit side as to bank account 30,000 for Mahesh. So here this is the excess capital of Mahesh, which will be withdrawn by him. So we are adjusting Mahesh's capital with bank account. He has brought in excess capital, so he will withdraw the excess capital. Now moving on to the next partner, if we see here for that is Suresh. Now Suresh total on the credit side is 41,000, but on the debit side, Suresh's total will be 51,000. So here if we see for the second partner Suresh, debit side is more. So write the total on both the sides. It is 51,000. On both the sides, we have to write the same total. So here the debit side total is more than the credit side. So here he has to bring in additional capital. His balance falls on the credit side. We write it as by bank account, which means that he has a deficit or deficiency in the capital. As the debit side is more and credit side is less, so it will be 51,000 minus the credit side total 41,000. 10,000 rupees is shortage in the capital, so he has to bring in that capital into the firm. So the shortage amount of Suresh is being adjusted in bank account. So we write as by bank account deficit capital, which is to be brought in by Suresh, rupees 10,000. So this is how we adjust the partner's capital account. Now for the new partner, that is Rakesh, the total of credit side is 26,000 and the debit side is also 26,000. So both the sides it is same. So he need not bring in any additional capital or withdraw any additional capital from his account. So he brings in capital 26,000 and 2,000 rupees is given as goodwill for the partners. So after balancing, we get 24,000 as his new capital. Now here When there is the capital accounts adjusted in cash or bank, there is a need to prepare a bank account to find out the changes that has taken place in the bank. So first, in the bank account, we will bring down the balance, that is the bank account from the old balance sheet, which will appear on the debit side as to balance brought down, that is 15,000. This is the amount which is given in the old balance sheet. Now here in this firm, the new partner brings in capital. So all the changes that are taking place to the bank should be brought down to the bank account. So now here the new partner comes in. The new partner is Rakesh. So he brings in capital, rupees 26,000. So when it is comes in, so we write it on the debit side as to Rakesh capital account, the capital of the new partner 26,000. Now, what are the other changes that had taken place in the capital account? That is the adjustments made in the partner's capital account. One partner has withdrawn the excess capital and the other partner has brought in additional capital. So, which should be brought into the bank account. So, we are going to bring down the excess capital that is withdrawn by Mahesh, that is by Mahesh capital account, rupees 30,000. Since the amount of capital is withdrawn by him, the cash goes out. So it appears on the credit side of bank account as by Mahesh's capital account 30,000. And also a partner brings in additional capital, that is on the debit side, write it as to Suresh. So Suresh capital account had a deficit, so he had to bring in additional capital. So to Suresh capital account, he had to bring in rupees 10,000 as his additional capital. Now we are going to balance the bank account. So find out the total of the bank account. On the credit side, it is 30,000 and on the debit side, it is 51,000. So the highest total will be 51,000 on both the sides, and therefore here 51,000 minus the credit side amount 30,000, the balance bank account which will appear in the new balance sheet will be 21,000. We write it on the credit side as by balance carried down 21,000, which is the actual bank balance which will be appearing in the new balance sheet after admitting the new partner and adjusting the partner's capital accounts. So here this has to be brought down for the next period. So show it on the debit side as to balance brought down 21,000, and we are going to transfer this bank account to the new balance sheet. So in the new balance sheet, the bank amount will be 21,000 and not the old value, as the changes have taken place to the bank account through the adjustment of the partner's capital account. So now we are going to prepare the balance sheet. The balance sheet as on 1st April 1st April 2025. Now we are going to bring down all the assets of the old balance sheet along with the adjustment. Now let's see the preparation of the balance sheet. Now we are going to bring down all the entries which are given in the old balance sheet, and if there are any adjustments that will be made in the new balance sheet. So first on the asset side, we'll prepare the first entry is stock, and there is no adjustment for stock. So bring the stock to the asset side as it is. That is stock 39,000. Next we have is the debtors. For debtors, we had a adjustment, that is new PDD. So when we calculated the new PDD, the PDD has increased from 2,000 to 3,200. So we are going to bring down that adjustment here in the balance sheet. So write on the asset side, debtors 32,000 we have, and less the new PDD rupees 3,200. The balance amount of debtors will be 28,800 on the asset side of the balance sheet. Now next we have is the land and buildings. Now here again for land and buildings there are no adjustment. So bring down land and buildings as it is on the asset side of the balance sheet. Now next what we have is machinery with adjustment. So machinery is rupees 36,000 less the depreciation 3,800, which will be 32,200 on the asset side of the balance sheet. Moving on to the next item, that is we have the motor car. That is again we have an adjustment. So motor car is rupees 8,000 in the old balance sheet, less depreciation 1,600, which will be 6,400 in the new balance sheet on the asset side. Now moving on to the next item. Next we have is the cash at bank. So cash at bank is a new cash at bank which we had calculated under the bank account, that is 21,000. The balance we derived in the bank account. Now the next item what we have is the prepaid rent which was given in the adjustment. Since it is a prepaid rent, it is treated as an asset. So prepaid rent rupees 600 will appear on the asset side of the balance sheet. So these are the entries in the balance sheet asset side. Now moving on to the liabilities of the balance sheet. First we have creditors 40,000. There is no adjustment for that. And next we have is the bank loan. Even for bank loan there is no adjustment. So we are going to write it as it is, bank loan 8,000. And now we have to write all the capitals, that is the new capitals which we had calculated earlier in the working note. That is new capital calculated based on the new profit sharing ratio. The capitals of all the three partners. Mahesh capital will be 48,000, Suresh capital will be 48,000, and Rakesh capital, the new partner, will be 24,000. This is the balance carried down from the partner's capital account. So total capital is 1,20,000. Now this entries in the balance sheet are done. Now find out the total of the balance sheet. The total of the balance sheet on the liability side is 1,68,000, and also on the asset side the total will be 1,68,000. So with this, the capital adjustment under admission is completed. Hope it is clear, students. So we will see another sum in the next class. Thank you.